Let's find out how should one curate an investment portfolio to maximize profit and minimize the losses due to the current uncertainties. The uncertainties like Russia-Ukraine war, global central banks rate hike spree, and much more. But to discuss this, we have Mr. Arnav Pandya, who is the founder of Moneyeduschool, and he's joining us today right now on ET Now. And good evening, Mr. Arnav, and thank you and welcome to the show. My first question to you is that given the uncertainties looming over the world, where is the opportunity lying in terms of market, be it developed or emerging markets, and what kind of return expectation should we keep from the equity markets?
So if you look at the world scenario, see the biggest market for investment is the US market. But if you see the entire situation in the US, there is still a lot of uncertainty in terms of whether there will be a recession, what kind of slowdown will be seen, because there's this big debate going on whether there'll be a soft landing or a hard landing. So situation in the US is at the moment is not apt for investment. Similarly, if you look at Europe, the woes of Europe are only going to increase this winter. And if you even look at the recent developments which are coming out, wherein Russia is now mobilizing more forces, they have set a date for the referendum in the areas which they have taken from Ukraine. So all these point to the fact that the Russia-Ukraine conflict is not going to end. And with the energy crisis that Europe is facing, economically, it's going to be a very tough spot for Europe over the next 4 or 5 months. Similarly, if you turn your attention towards Asia, you find that China has problems of its own. So the zero COVID strategy which they are following is again a bit detrimental to economic growth. Similarly, the problems which you see in the housing market and the inability of people to repay loans and not pay their EMIs, all that is also bringing the construction and the financial sectors under great strain. So looking at all these factors in terms of markets and investment opportunities, the domestic market looks like one where there is a far better chance or a far better allocation is required to this, because you will find that the kind of growth that you see in India, the kind of stability that you see in India, and the benefit that you will see as the global economy deflates, that is going to be crucial in terms of the allocation that an individual can have.
Okay, thank you so much for highlighting how the scenario is turning out to be in different asset classes. But Arnav, would like to have a sense on what's the right balance during such uncertain times, because from gold to we see bond yields and even the equity markets are so much volatile. How should one place themselves in terms of strategy they should follow, and what's your perspective on diversification?
So if you look at the overall strategy that one has to follow, then one simple rule that is always followed is that do not keep investing lump sum amounts, because that exposes you to the risk of having a one-time investment cost in your investment, which then becomes like an anchor to your entire investment amount. So keep spreading out the amount as much as possible, and which is why the regular investment route and the systematic investment route is the best way to go about this process. It is normally the best way to go about, but in volatile times like these, this becomes the best route to ensure that your portfolio is diversified. Now let's come to this angle of diversification. See, normally, whenever you are creating a portfolio domestically, you will have diversified across sectors, across asset classes, across market caps also in your equity portfolio. So then the question that remains is that what happens to the geographical diversification? And geographical diversification means that you are investing across many countries. Now, the normal and the easy way of going about this is to get a mutual fund which has an international exposure. The problem at the moment is that most of the mutual funds which invest abroad, they have frozen investments because the investment limit is reached by the industry. So that leaves very little options for an investor to even take an exposure except through specific exchange traded funds which are still open for investment. So this means that your choices of going abroad and even investing internationally is limited unless an individual takes the route of direct equity investing, which is through the liberalized remittance scheme, whereby every individual can put in up to $250,000 abroad. But that doesn't give you the same benefit as a mutual fund portfolio because the diversification is less and you have to choose individual stocks on your own. So at the moment, an investor can adopt two techniques if they want to diversify geographically. One, go in for those ETFs, again in a systematic, regular investing manner, which are open for investments and where the indices are broad based. So an S&P 500 index or even a NASDAQ 100 index, if you are looking for those kind of exposures. Or the other way is that there are some equity funds in India where a part of their portfolio has a foreign exposure. So if you invest in those funds, those are open for investments, but they have frozen their foreign exposures. So you will still get some amount of foreign exposure just by investing in those funds. Those two are the options left for you at the moment.
So that's all about when it comes to strategy as well as diversification. But Arnav, what we see is that gold is one of the safest haven, what we think. But the gold prices are at 2.5 is low. We saw a sharp up move coming in when the Russia-Ukraine war broke. But now the gold is giving actually a negative return on a YTD basis. How should one manage the allocation of this in the portfolio? Is this a right time to rebalance that? Or if somebody is looking at to make some fresh entry into the gold, is this a time to get into that?
So normally when we look at the kind of commodity exposure or a precious metal exposure, our first attention goes to gold. The problem with gold at the present moment is that while it is an area of safe haven, the rising interest rate scenario across the world and the manner in which the dollar is strengthening, that is not good news for gold, and it could be some time before gold actually gets back on its growth path in terms of its value. So in terms of your portfolio exposure, normally up to 10% is the kind of exposure you can have to these kind of precious metals. So my choice at the moment would be that if you have some exposure to gold, you can continue with it. You can even keep adding a bit to the gold exposure. There's nothing wrong with it. But at the same moment, there is another opportunity which is there, which is in terms of a silver exposure. Now we have silver exchange traded funds also, which are present in India, which have just been launched over the last 1 year. And silver, if you see, because it has an industrial use as well as precious metal use, there is actually a greater weakness which you've seen in silver, which makes it far more attractive. Because if you look at the future, there are two main factors which could affect silver, which is one is that the falling output in terms of supply, and second is that the increasing use of silver in green energy projects or green energy industries, which is going to give a new fillip to this kind of development. So my suggestion would be that in your 10% exposure which you are giving to precious metal, keep your faith in gold, but at the same time also you can add a bit of silver to it because the opportunities there are also better.
So that's the take coming in when it comes to strategy, diversification, and as well as your exposure to gold. But Arnav, it was a very enlightening discussion with you, but we'll not let you go on that. It's time to get some of our viewer queries answered. And today we have a question coming from Balaji. He says that I've been investing since 2012 and there are actually 8 active mutual fund schemes and 14 inactive mutual fund schemes which are not yet redeemed. Arnav, he wants to know from you if you can please suggest how do he trims this portfolio in a tax efficient way. What should be the strategy?
So the first thing is that having so many funds in your portfolio itself is not a very good thing to have, because while we want diversification, having say around 20-21 schemes, which is the case here, is actually a case of over diversification. So the first thing that needs to be done is to reduce the schemes. Now, which are the funds which need to be looked at first? Ideally, the ones which are inactive, where there is no SIP going, those are the funds where he should start looking at in terms of how to sell off these funds. The second thing is that since the investment is all long term in nature, since it has been started a long time ago, all of these funds would now be in the long term capital gains category. So the benefit there is that every year, if you book long term capital gains, the first 1 lakh is tax free. So that benefit needs to be made use of, and accordingly the funds can be sold off from the existing list. My suggestion would be that of all the inactive funds, there are just 3 funds which stick to the portfolio allocation which he needs, and those 3 funds are the Franklin Blue Chip Fund, because he has no large cap fund in his other exposure, HDFC Small Cap, and ICICI True Value Discovery Fund. Apart from these funds, all the existing inactive funds can be sold off, and this can be spread out over a couple of years also, in the sense that after March you come into the next financial year, so that the tax burden is minimized, and these can be pruned, so then the portfolio also becomes manageable, and you are also achieving your objective of getting the money out from the existing funds which is just lying there.
Balaji will take care of that, and thank you so much, Arnav, for joining us on ET Now and helping with your take on the markets, the strategy to divest, and also helping Balaji with his investment portfolio query.